Welcome to Defeating the Silent Thief, Inflation-Proofing Your Retirement Portfolio. Today we will explore strategies to protect your savings from the corrosive effects of inflation. Inflation is the silent erosion of purchasing power. Even a steady global core inflation rate of 2.8% can destroy wealth over decades, as money saved today buys significantly less tomorrow. The illusion of safe money shows us that the real return is the nominal return minus the inflation rate. Traditional bank deposits often yield a negative real return, meaning you lose wealth while your money sits in the bank. Equities offer a shield through pricing power. As raw costs rise, strong companies can raise prices, protecting profit margins, which ultimately helps share value hold. This allows equities to outperform inflation in the long term. Government-backed inflation defenses include TIPS, where the principal rises with the Consumer Price Index. I-bonds and inflation-indexed bonds are other instruments that tie returns to inflation rates. Real estate and REITs offer tangible protection. Physical real estate holds intrinsic value, and landlords increase rents with the cost of living. REITs provide stock market liquidity and typically pay high dividends. Gold acts as a traditional safety net, storing value against currency devaluation. Commodities like oil and agriculture drive inflation, and their prices rise during inflationary cycles. Accessing them via diversified ETFs can be a safer approach. The inflation defense matrix helps compare assets. Equities are for growth, while TIPS and IIBs are for preservation. REITs offer high income, and gold serves primarily as a hedge against inflation. To adapt to rising rates, consider floating rate bonds. When central banks raise benchmark rates to curb inflation, the dynamic coupon rates on these bonds automatically increase your income stream. Defend against healthcare inflation by reviewing your insurance for adequate sum insured and restoration benefits. Additionally, isolate a dedicated medical fund and invest it aggressively to outpace extreme cost increases. The laddering strategy for fixed income avoids locking all funds into one maturity date. By spreading deposits across different maturities, you can reinvest maturing funds at potentially higher interest rates, maintaining liquidity. Regular rebalancing is essential portfolio maintenance. Inflation changes rapidly, so review your asset allocation annually. Sell outperforming assets and buy undervalued ones to maintain dynamic risk alignment. Neutralize rising costs with step-up systematic investment plans. Unlike standard savings, these automatically escalate your investment amount, ensuring your savings rate matches your rising lifestyle costs. The retirement fortress architecture organizes these defenses. The central keep holds cash and bonds for preservation. Inner walls are equities and REITs for growth. The moat includes a healthcare fund and bond laddering for defense, and the patrol is regular rebalancing and step-up SIPs for maintenance.